We need really to look at the data as they come. I mean, we live in a very high uncertain times, and therefore it is not obvious really to understand all the trends. We have to look at them one by one carefully. We have to be, I think, cautious. It does not mean that we stop, or it means that we decide meeting by meeting on the basis of the information that we get.
We can look at the data right now. The Eurozone economic rebound gaining momentum. April PMI showing resurgent service sector activity. US PMIs just crossing the wires right now. Let's get you the team coverage. Maria Tadeo in Brussels, Ed Harrison in DC. Ed, better than expected and waking this bond market up just a little bit.
Yeah, very good data. Not as good as in Europe, but definitely better than expected. And I think in particular, when we look at the manufacturing, it was expected to be at a 49 handle, which is contracting. It was above 50. So I think in general, what it's saying is that the economy is more resilient than we anticipated. And in particular, the services sector, which is the larger component of all these economies, is doing well, both in Europe and in the United States.
50, the dividing line between expansion and contraction, 53.7 on the services PMI, the previous read 52.6. Ed, just a word on jobless claims if you can. Jobless claims, I think, spooked people in the other direction. Claims kind of breaking out over the last couple of weeks, yields lower. Yields have bounced on this print, I know, but Ed, just a final word on claims, please.
Yeah, I think that what claims are telling us is that we're not out of the woods yet, that what we're seeing relative to a year ago, relative to 6 months ago, is that claims are coming up, both in terms of initial claims and in terms of continuing claims. So what it says here is that the U.S. economy is slowing. The question is what's the pace of that slowing, and is it going to have extra oomph as a result of the credit crisis and also potentially a debt ceiling crisis?
Just to recap that data for you, as Ed pointed out, manufacturing with a 50 handle. We were looking for something with a 49 handle. Again, that dividing line between expansion and contraction, 50. Manufacturing coming in at 50.4. Services PMI at 53.7. The composite PMI for the month of April, a preliminary reading coming in at 53.5. The estimate 51.2. Previous read 52.3. Maria Tadeo, I have to say, the services story in Europe looking pretty decent.
It is, Jonathan. And look, when you look at the PMIs for April, it was a beat and would also suggest there is, in fact, momentum in the European economy going into Q2. But you talked about the services. The issue here is that when you look at the details, and this is where it gets cloudy and it's difficult to read, yes, the overall number is good. Yes, services, in fact, are gaining momentum and expanding. But when you look at the manufacturing in the euro area, it is in contraction. Now, the question is, what matters most, the manufacturing sector or the services? And it really depends who you ask, but also the type of economy that you run. If you're a big industrial country like Germany, obviously it's not good news. If you're a service-led economy, probably also means that you're adding jobs. The issue here is that for the European Central Bank, the fact that there is this growing divergence, it makes policy more difficult. Now, we know that there is a decision coming up in about 2 weeks on May 4th. This is a central bank that has said we're going to be now meeting by meeting, very data dependent, but there isn't a single trend. And that is exactly what the head of the Italian Central Bank, Bank Italia, that you played at the top of the show, alluded to. There isn't a single trend. What is clear, though, however, when you look at the different voices at the Governing Council, is that they will most likely hike again in May. The debate, and this goes back to the data, is the magnitude of this hike. Also considering, by the way, Jonathan, that this is the fastest hiking cycle on record for the European Central Bank already.
A much faster, much quicker, much higher than anyone anticipated, including myself. I had no idea how far the ECB would go. I struggled to think they were going to get past zero when we were in the depths of the pandemic. Just a final word on the Bank of Italy governor, speaking to Francine Lacqua. Great exchange, really good conversation about a meeting-by-meeting approach to ECB policy. You can find that in full on Bloomberg.com and on the Bloomberg terminal. Maria went through the dates. May 4th for the ECB, Ed Harrison, May 3rd for the Federal Reserve. It's the final day of Fed speak, Ed. Your wrap of what you've heard so far this week, to me at least, Ed, a lot of these guys are on the same page.
Yeah, I think that the page they're on is that we're going to hike one more time, and then we're going to be done, and we're going to keep it at a high level, at that plateau for a long time, until we see inflation, near 2%. So the bar for the Fed to actually cut is incredibly high, especially when you see data coming in like this. So what it says is you have to see the inflation come way down. We're talking with a 2 handle, somewhere around 3%. And we also need to see some sort of weakening in the economy, severe weakening. So all of the cuts that are priced into the market, Fed funds futures, they're going to have to be priced out over time, because what we're seeing now is that the economy can withstand what the Fed's dished out over the last year.
Yep.
And therefore we're going to keep at that high plateau.
Ed, appreciate your time, mate. As always, Ed Harrison there, and Maria Tadeo out of Europe and out of Washington as well. This bond market's flipped. Yields were lower, now they're higher. Off the back of those US PMIs, yields are up by 4 basis points on a 2-year, just below 420. That's a turnaround in the last 10 minutes. Up next, your trading diary.
Great questions.
The economic data better than expected. 25 minutes into the session, call it 26. The Nasdaq lower, yields higher. We're down 0.4% on the Nasdaq, down about 0.1% on the S&P 500. Equity softer. Let's get to the trading diary. 2:15 Eastern Time. You'll hear from President Biden. Fed Governor Lisa Cook on tap ahead of the Fed's quiet period. Looking to next week, more earnings on deck. First Republic on Monday, Alphabet, Microsoft Tuesday, Meta on Wednesday, then on Thursday, Amazon and Intel, and we round out the week with US GDP. From New York City, that does it for me. Enjoy the weekend. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes to the U.S. trading day on this Friday, April 21st. Here are the top market stories that we're following for you at this hour. And the survey says U.S., UK, European services PMIs re-accelerate. We're going to speak to the man behind the numbers, Chris Williamson of S&P Global Market Intelligence. Now, what the survey says to central bankers, investors price in 50 basis points of cuts still from the Fed this year, while officials talk up one more and done. And then what the survey says to markets, not much. Stocks a little under pressure, sure, yields inching their way higher. We're going to break it down. From New York, I'm Alex Steele with Danny Berger over in London. Guy Johnson is off today. Welcome to Bloomberg Markets. Danny, I gotta say, these numbers, whether you're in Europe, the U.S., UK, they're stunning services numbers. And this even more impressive. This is the first survey read for PMIs that we got since SVB collapsed.
And it's even more impressive considering what the sentiment is out there, Alex. You and I talk to people every single day who say a recession is coming, but the data is not bearing that out.
Yeah, and you have to wonder then for equities, have we then priced in that recession? And now we're really truly looking towards 2024. And then why the market's still pricing in those cuts? Either we're going to decelerate really fast or the market has to re-rate really fast.
Yeah, I mean, it's can you look past the recession?
Mm-hmm.
Can you trade what will happen beyond it? If we haven't gotten to the recession yet, does that mean the pain has not yet arrived for the equity market? But Alex, a lot of this comes back to just where we are in the economy. We know that the Fed says they're close to done, but we don't know what the actual economy is looking like. And that brings us to our question of the day. Is the economy reaccelerating? Joining us to discuss is someone who knows this PMI data extremely well. It's Chris Williamson, S&P Global Market Intelligence Chief Business Economist. So, Chris, given these numbers, given we're an expansionary for both services and manufacturing, is the American economy accelerating?
It certainly looks like it is, yeah, defying all expectations, really. We've got faster growth, most notably in services, which we've seen for a couple of months now, but that's now being joined by a revival of growth, just modest, but in the manufacturing sector as well. So it looks like we're off to a good start in the second quarter, growth accelerating on the first quarter.
Can walk us through what's the strength, like the strength across the board, orders, pricing, outlook. Just walk us through all the highlights for the U.S.
The U.S., which is a pretty similar story worldwide. It's just the US seems to be ahead of the curve a bit, as usual. But what we're seeing here really is service sector led growth. And when I say service sector, it's not across the board. There's a big spurt of demand that we're seeing for consumer services and things like travel and tourism. So this is the first year, don't forget, that we've had, if you like, a tourist season kick off this year with unfettered global travel. You've not got to worry about PCR testing. You've not got to worry about quarantining, anything like that. And people have booked in advance in the knowledge that this year is going to be a safe one to travel. And we're seeing that across the board here in all the countries that we're looking at. It's driving growth quite strongly. What we're also seeing is financial services activity really coming up quite nicely now. The dark days of late last year when financial conditionings were tightening very severely, those conditions have loosened. And that's brought financial service activity up high with it, from things like the banking sector to real estate. It's all turned a corner. So you've got this nice headwind, tailwind, if you like, from the pandemic. But so this is driving this growth now. In manufacturing,
Chris, if I can jump in here, because what you're saying to me, what it sounds like to me, is the Fed has a long way to go. Do you think that's fair?
It's looking like it. In this respect, but there's so many caveats to this growth, because if it is indeed all based on this pandemic tailwind, that's going to fade. That's going to fade as we go through the summer, and what we're left with in the second half of this year really is the economic fundamentals kicking in. Everyone's got through this bit of exuberation, if you like, and we're left with the fundamentals of high cost of living. Yes, inflation's coming down, but the price rises have been there, right?
Yeah.
You've got higher cost of living. That's kicking in, and higher interest rates, of course. Those fundamentals are inevitably going to increasingly feed through to weaker growth as we go through into the second half of the year.
But, you know, I mean, I just look at the new orders in the U.S., the highest rate in 11 months. Businesses passing on higher costs to consumers. We're looking at the fastest jump in output prices in 7 months. The degree of confidence in the economy also rising. None of this says to me recessionary fears.
At the moment, no. This is what we're going to have to wait for and see how it plays out. In terms of the inflation picture, things have shifted. You're getting strong downward price pressures in manufacturing as the supply's improved, but it's the reverse in the service sector where supply's tightening. We've gone from worrying about getting enough components on ships to getting enough people on aeroplanes now. US airlines are maxed out. They can't put any more people on there. The demand is there. So what happens? You hike your prices. And this is what we're seeing in the service sector now. So a complete shift from what we were seeing a year ago for goods inflation rising. Now you've got the constraints in the service sector.
Chris, why is manufacturing lagging so far behind in Europe when in the U.S. we can see it's no longer in contraction anymore?
Two reasons. One is strikes in the UK, but most importantly in France, where it really dragged activity down. But more importantly, what you're seeing is a difference in the inventory cycle. The US manufacturing sector seems to have cleared out its inventories that were built up over the pandemic faster than we've seen in Europe. Europe's still really in the thick of that inventory clear out. So there's weak demand there, especially for intermediate goods, components that goes to other firms. In the US, that story is more played out, so it's acting as less of a drag. So you've not got really strong growth in manufacturing, but it is looking better in the US than Europe. And it's that inventory cycle, the change in timing of that's playing a key role here, I think.
Such a good point, Chris. Unfair question. For the ECB and the Fed, they look at this data. What should be their takeaway when they're looking at their hike cycle?
Well, look, this is hawkish, isn't it? This is hawkish across the board for all central banks, whether it's the ECB, the Bank of England, or the Fed. It's going to lend weight to the hawks who are saying, look, it's just not right to take your foot off the pedal now. You know, we need to get the inflation genie back in the bottle. And at the moment, it looks like it's still going on there. Because if you look at these price pressures, they're accelerating in the service sector. That's not what you want to be seeing at the moment.
Chris, though, is it enough? Because, I mean, they've been hiking a lot. They've been hiking fast. It's clear the consumer is still strong. They're still spending. Does something else need to change? Is it the role, perhaps, of fiscal governments now to try to rein the consumer strength in?
Well, look, the fiscal stimulus we had, especially in Europe with the energy help, that's going to fade. So that's going to act as a headwind here, taking some of the steam out of the consumer market in particular. So that will come to bear, I'm sure of that. But, you know, what we've been saying all along this year is, look, you're going to get a nice kick from the sort of winter, the winter depths that we had, with all the concerns about energies and recession, that alleviating as people can travel more this year. That's going to provide this. It's a little bit like a dead cat bounce. We do think that's going to fade because the fundamentals are already there, irrespective of fiscal policy, that you're going to have a weaker tail end to the year. So I think just wait and see how that plays out. But I think digging down in all the sub-indices of these data, that story is very much still intact here. Enjoy this, you know, companies are enjoying this while the sun shines. They're making hay this spring, this summer, but I think most are preparing for a tough winter ahead again this year.
Well, that is probably the best sentence. This is a dead cat bounce. Enjoy it while it lasts, basically. Hey, we just want to get you before we let you go. UK, same story that we're seeing in Europe and the US mostly?
Same story, but in the UK you've got even more constraints, notably on the service sector, notably on the labour market, that's pushing those price pressures up higher. The UK is in the worst of both worlds here. So even more pressure on the Bank of England to keep hiking interest rates, I think.
Interesting, particularly after all the wages and inflation stuff. Hey, Chris, it's great to get your perspective, particularly in a day like this, to just parse through it all. Chris Williamson, Chief Business Economist at S&P Global Market Intelligence. So coming up, we're going to put the question of the day, is the economy reaccelerating? To Kim Forrest, Boca Capital Partners founder and CIO. And what's she doing if this data is a dead cat bounce? This is Bloomberg.
Election season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Can we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The consumer's in good shape. They have more money in their accounts than they did by the pandemic by multiples, especially the lower stratas. The ones that don't have it are the wealthiest consumers on our platform because they put the money first in the market, now in the money funds. So the credit quality is unbelievable, and so that's good news. Are we putting up provisions? Yeah, because we keep planning on this recession. It seems to always be out there that we haven't gotten to yet.
Brilliant end to that statement. Bank of America Chief Executive Officer Brian Moynihan at Bloomberg Sell-Side Leaders Forum in New York City yesterday. And that sets us up really well for the question of the day. Is the economy reaccelerating? We're all waiting for the recession, and it's still not coming. And the data today really proves that. I want to welcome Kim Forrest, Boca Capital Partners founder and CIO. Is the economy reaccelerating, Kim?
Well, I don't know that it's like on super high octane reaccelerating, but we always kind of come out of Q1 worried, right? I think a lot of the data that we get is over-managed for seasonal, things that happen, and I think the data is always over-massaged. So I think the economy continues to perform. I think that inflation is coming down, and it's coming down more rapidly than we think, again, because of data massaging, especially in the owner's rent equivalent that we get on CPI. So if you take that out, like you can actually go to the grocery store and pay less than you did a month ago. So I think I'm all in on that. So I think things are going to be okay this year. I don't know what that means. I'll tell you at the end of the year. But I do believe that, we're not on the precipice of recession. And I feel really alone in this, or maybe Brian Moynihan is there with me as well.
Yeah, I mean, look, I said it at the top of the show. I'll say it again. Alex and I have talked to so many people who say, yeah, we're heading towards a recession. So, Kim, that also means everyone has told us they're fleeing to defensives, they're fleeing to quality. Are you doing something different then?
I do what I always do, which is growth at a reasonable price. I have a 3 to 5 year time period. So believe it or not, when we are really nervous about, like, is the economy tanking, unless it's the end of the world, and then who really cares about money, I'm always looking forward, and I'm looking for companies that are going to grow, because in the long haul, people are rewarded by growth. And that's what you have to remember. So if you're going to stock up on changing from like semiconductors to toilet paper companies, that second category really isn't going to grow. And when do you switch? And is just treading water your job? Yeah. I don't think so. I just don't.
So, Kim, what do you like now in this environment? We're talking to Chris Williamson, who does the data, the PMI data, and he was saying, look, the data's a dead cat bounce. Like, it's up now, but it's going to come down. This is like, take it while it comes. And I wonder how that applies to the equity market.
Sure. Well, again, if you have a longer time horizon than a year, I think you're a smart investor. And if you have a 3 to 5, or even like, let's say something crazy, like a 10-year time horizon, now we're playing into some interesting things. So AI, you've heard of it. It's probably a thing that's going to grow. And, let's invest in that. So semiconductors at a minimum and other software investments are probably going to be key. Here's a hardware one, NetApp. They create storage. And if there's one thing I know about AI, it consumes tons of data. And we're going to have tons of data forever and ever. And that's what NetApp solves, is keeping that electronic data.
Kim, I really love your notes on productive technology. And one of the things you get into is this idea that companies are worried right now, and we can see it in the earnings results for some of these chip makers. They're pulling back. At what point is it safe that we will actually see that growth you're talking about with companies investing in this type of productive technology?
I am not a market timer, so I would say look at the prices, the PE, whatever your favorite ratio is for any company that you've always wanted to own. Fix that price or that level in your mind and then just dive in and buy it whenever it reaches that level of comfort. No one knows what the future brings, especially day by day, month by month, but we have a pretty good year that the world is going to continue to grow. So you have to look at your investments that way, not at a certain level or time.
But Kim, based on that, does it matter then where the Fed hikes to and stays? Like, is your thesis disrupted if they do 25 and hold for a while? Is it disrupted if they wind up cutting in the back half of the year, for example?
No, those are great scenarios. Where it kind of crumbles, if somebody wins in the it must be higher than inflation category for longer, forever, like 7 or 8%. Let's just kill the economy. Let's do that.
I'm still thinking about what you said earlier, Kim, when you said everything's okay unless the world ends, and then who cares about money? I think that must be the most dark comment we've gotten, but hey, very true. Kim, quickly, when it comes to Tesla, some weirdness around their pricing. They raised some prices in the U.S., but overall they have been slashing prices. To you, how much of that is a Tesla phenomenon versus companies losing pricing power?
I think that's very much a Tesla problem. They would like to have more throughput through their factories as opposed to right now having better margins. Now, the investors seem to have turned on them for this, which is a bafflement to me. Elon Musk is not running a company for it to become a cash cow. That is not what he's going to do, is create a big dividend and make sure you get it every month, or every quarter. So he's running the company the way he sees fit. Now, the thing that worries me is cutting the price. Tesla is a luxury good, and nobody wants to buy the $1,000 Birkin. I'm sorry, they just don't. They want the $10,000 Birkin.
It's so
Kim,
true.
if I can get in the $1,000 Birkin, I will absolutely buy it. Just saying that now.
Are men mystified about what we're talking about?
Yeah, I think so. Let's quickly wrap this up before we confuse the male folk too much. Hey, Kim, really great to talk to you today. Kim Forrest of Boca Capital. Now, still ahead, speaking of Tesla, they're trying to reverse the slump in its shares linked to those price cuts. As I mentioned, now it's raising the price of several high-end models, still trying to be the Birkin bag of the car world. We'll have the details in the startup for you next. This is Bloomberg.
about that all day yesterday.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. Procter & Gamble has raised its sales projection for the year ending in June. The maker of Bounty paper towels and herbal essences shampoo cited higher prices and a slight increase in demand for some of its products. Meanwhile, P&G's quarterly results beat estimates in key metrics. The biggest global luxury conglomerate is shifting resources out of Hong Kong. Bloomberg has learned that LVMH wants to focus more of its investments in mainland China cities. Hong Kong used to be Asia's premium shopping hub, but mainland Chinese consumers have switched to buying luxury goods in their home cities. And Elon Musk is doing an about-face. After saying he would continue to drop the price of his EVs, Tesla is now increasing the cost of its Model S and its X vehicles in the U.S. Prices for the high-end models will be bumped up by $2,500, raising the cost of the sedan and SUV by 2% to 3%. Steep markdowns early this year took a toll on profitability and its shares. And that's your Bloomberg Business Flash. Alex?
All right, Angel, thanks so much. Appreciate it. It is 23 past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond. The Silicon Valley starts this morning. And joining us now is Bloomberg Technology co-host Caroline Hyde. Let's get to the Tesla price cutting. What? I don't get it.
It actually doesn't really matter, is the takeaway.
Okay, fair
because
point.
this is just the X and the S, which actually only made up 2.5% of deliveries. Basically, Elon Musk himself said these models don't matter. They're the high-end, more luxurious price points. The fact that you're increasing them by 2 or 3% just won't make that much difference to the overall bottom line. Yes, it's a signal that, look, there's still competition there for the Mercedes and the BMW, but really where he's cutting the prices is the threes, the Ys, the take on Renault, the take on Ford, where, of course, the Ford CEO recently said that he seems to be starting some sort of price war, and that's totally rational. But I do think it's interesting, ultimately, that we're seeing still a Model S and X that is far cheaper than it was at the beginning of the year. He's just ramping up a little bit. I think it's the timing that's interesting, the day after the numbers and the share price drop.
So, Caroline, what does it mean for Renault? Shares have fallen 13% in just this week because of those price cuts.
There is a great story on the terminal today, really talking about how a different car executive is now losing sleep at night because of Elon Musk. And before it was Mercedes that had to really pull back their EV price points over in China because of what Elon Musk did with Tesla and the BMWs. But now his real focus is on scale. It's on the cheaper price point. It is on the Renaults, on the Fords, and they are starting to perhaps worry and see that they're going to have to ramp up their own profitability. Now, just remember, even with Elon Musk cutting prices as he is, their operating margin is more than 11%. Compare that to the Fords, the GMs, where they've got 6%. 4%, he's still far more profitable than others.
Yeah, exactly, which should scare them a lot more. So to that point then, is this going to be, are we going to look at Tesla as like a traditional car company in that they're going to have low-end models that they want to do, and then they have the high-end models where it's really expensive and like they can nicely get the cash cow from the expensive models and then go ahead and produce a lot of their lower ends?
And I really wonder how they manage to keep that allure of you were just talking about Birkin bags. How can you ensure that you still got that je ne sais quoi of the really high-end luxury without perhaps
cannibalizing?
Cannibalizing by the fact that you've got a cheaper product up there. How can you make sure that they're still that much more desirable even though they've got a lower price point and different options?
Fair point.
Yeah, we've seen that with a lot of designers. When they have lower price points, it kind of hurts the brand. Hey, Caroline, less than a minute here, but can we talk about the blue checks? They're now gone for the legacy blue checks, if you will.
Wah, wah, mine's gone. Don't know about yours. But, I mean, it's been hilarious following all the commentators on Twitter about whether or not they care. Haley Berry out there with some great memes. But I am interested more to the point of ones that seem to have kept their blue checks, even though they said they didn't want them. Stephen King in the UK, the author. We see LeBron James still has a blue check. And get this, Elon Musk says he's paying personally for some. Why? But it is starting to be whether or not ultimately this works, whether people find that the product isn't as good when you don't have people with blue checks being able to sort of rise to the top of your overall feed. So it'll be interesting as to who does, who doesn't keep them, whether it becomes some sort of signposting, signaling of your political affiliations or not. But at the moment, it seems to be causing more confusion than anything, but Elon likes to do that.
Very interesting. Caroline, thank you so much. That's Bloomberg's Caroline Hyde. And of course, you can catch her as co-host of Bloomberg Technology in about 90 minutes time. This is Bloomberg.
We're an hour into U.S. trading session. You got those PMI services numbers coming in super strong, and the market's actually trying to claw its way into the green. Abigail's trying to track those moves for us. Abby?
Yeah, it's an interesting day because we did have those super strong PMIs. Rates shot higher, stocks went lower, but by about 0.3%, kind of fitting to the action we've had all week. This is a 5-day chart of the S&P 500, and it's really kind of a meh week, not a lot going on here. And right now, not only do we not know how we're going to close on the day, we really don't know how we're going to close on the week. Just a small decline right now after all of this very small back and forth movement. And of course, it is options expiration, so volumes are higher. As for the stocks that really moved in the week, healthcare dominating to the upside, both Intuitive Surgical and Abbott Labs, two of the S&P 500's top performers. Great earnings. Tesla down about 11.6% on the week. I'm guessing that's the worst week since early January. And of course, then that margin disappointment. And now today we have this news about the fact that they're raising prices on two of the pricier models just a little bit. Seems to be more about optics around that gross margin story. AT&T down 8.3% yesterday, the worst day since 2000. That free cash flow miss that we talked about yesterday, plus subscriber losses weighing on shares. And then finally, it of course has been a week of the regional banks. There have been a lot of losses, but here are two banks on the week that are higher. First Republic up 9% ahead of reporting on Monday. So it seems as though investors think that the story has stabilized a little bit. And then M&T Bank up 6.3%, a legitimately good quarter deposits numbers right across the board. So here's a bright spot on the week, Danny.
Oh, we all need a bright spot to end the week. Abigail, thank you so much. That's Bloomberg's Abigail Doolittle. Now, one stock, though, regional banking stock that is falling today is Regions Financial. Rounding out the week's bank's earnings with deposit flows coming in line with expectations, but shares falling more than 1.5%. Bloomberg's Sonali Basak joins us for more. Sonali, was there something disappointing in there to investors then?
There are a few things that fell below expectations, even with net interest income coming in pretty healthy here. You do have deposits that were below expectations, charge-offs that were above expectations, provisions for loan losses also, Danny, that were above expectations. Now, it was interesting because all week we have seen these banks kind of show some sense of stabilization, which coming into this, given the sell-off you have seen, you would expect that that could have been maybe enough. But the idea here that we're not completely out of the woods with the pressures that are being seen on the system is really being seen. The KBW Bank Index this week, I'd like to say it's up, but at this point it's pretty much flat. And so, you know, one huge week of bank earnings and not a lot of, you know, fears calmed completely.
Oh, there was a journal article that talked more about what kind of regulation we're going to see from D.C. And none of it was really surprising, but it's basically taking the available to sale assets and having to provision for them if you're a bank over $100 billion. In reality, is that going to happen, and who gets hit?
Well, there are a couple things here. How fast regulation moves in Washington in this environment is one thing, but another part of this is also supervision. And I think very quickly on May 1st, we're slated to, or by May 1st rather, we're slated to hear the Fed's own report on how Silicon Valley Bank was handled. Remember, Monday we hear from First Republic. Were there regulatory questions there as well, not just on the assets held here, but the loans that they were giving as well that has made some of these assets unattractive for potential sales or anything of the like. What's interesting also, in addition to the regulation, is you look at Regions Financials talking about how they're not needing to really sell any assets at this point. And by the way, to your point on the available for sale securities here, selling anything at any sort of loss is not the greatest thing for some of these banks. But at the same time, selling some assets surgically, as the Western Alliance put it, is showing you that there's still a healthy capital markets with or without kind of this near-term change in regulation.
Fair enough. Hey, Sonali, thanks a lot. It's been a big week for you. We really appreciate your time. Bloomberg Sonali Basak joining us there. Okay, another regional bank reported this week at Huntington Bank shares. Their first quarter earnings did beat estimates. Total deposits came up a little short. The stock is down about 2.5%. 5 days, it's up 1%, but it's down over 2.5% over the last 2 days after reported earnings. With us now, Huntington Bank Shares CFO Zach Wasserman. Huntington is based in Columbus, Ohio, and operates in 10 states. Zach, it feels like it was a little heavy with the deposits. Has the deposit outflow stopped, and do you forecast a building of deposits?
Our deposits were actually very stable and growing in the first quarter. It was the fourth consecutive quarter in a row of growth for Huntington. And yes, Alex, we do forecast continued growth for the rest of the year. You know, I think there's been a bit of a divergence in the performance across the group, but by and large, we saw regional bank deposits, you know, pretty stable, and for Huntington, we grew.
What do you need to do to make sure you can hold on to those deposits? We have seen a move en masse among your peers to money market funds to grab that yield. What are you going to have to do to keep customers and attract more, perhaps?
You know, for us, it comes back to our focus on primary bank relationships and really loyal, sticky relationships that are founded in our fair play philosophy. We've been growing primary bank households at a really steady and consistent pace for the last several quarters, and so that's the key for us. Obviously, we'll need to price deposits appropriately, and we're doing that, but it all comes back in the end to the relationships and service that we provide to the customers.
So, Zach, I'm sure that SVB would have said the same thing, and then they were sorely disappointed. I think we're just trying to get at the deposit beta. Are you going to have to increase what you pay on deposits, and how fast can you do that?
Yeah. Ultimately, we are going to increase deposit beta over time through Q4. It was 25%. We're estimating it'll continue to rise over the next several quarters. But I would say as well, one of the key statistics that for Huntington as a differentiator versus Silicon Valley Bank is the insured percentage of deposits. For us, 69% of deposits are insured. For Silicon Valley Bank, as I understand, that was less than 10%. So that sort of is the fundamental driver of stability for larger regional banks like Huntington.
Zach, are you being more conservative with your loan portfolio?
You know, I wouldn't call it conservative per se, but certainly we're being very judicious around where we grow the loan portfolio at this point. We grew in the first quarter just around 8% on a year-over-year basis, and we're expecting for the balance of the year between 5 and 7%, focusing in on some of the core areas that we've been seeing strengthen over time, like equipment finance, asset finance, and our commercial business more broadly.
When you talk to your clients over the Midwest, where are the weak spots? Where is loan demand kind of petering out a bit?
You know, I think on the consumer side, certainly residential mortgage has been an area of pressure, and that's been well reported and documented, just given the level of interest rates and the availability of home supply. So that's an area where we're seeing less demand on a year-over-year basis. Auto and RV Marine is another area that's fairly steady, not growing significantly. Broadly speaking, the commercial side for us is where we're seeing the strongest demand.
Have you seen any clear difference since the banking turmoil when it comes to your customers? And what is the difference in behavior you're observing, if so?
You know, broadly speaking, I would say it's very stable. I think if there's anything, this has raised the awareness of customers of two things. One, where they're putting their deposits and the strength of the institution that they're banking with. And secondly, what price they're getting. And I think there's clearly, you know, an optimization going on there, which is very reasonable and logical.
When we're looking ahead, Zach, we're looking at what's going to come out of D.C. And I appreciate that regulation can move really slowly. But the idea that banks with over $100 billion in market cap are going to have to account for the available for sale securities, any kind of potential write-downs, that could definitely crimp buybacks, it could crimp loans, it could hurt earnings. How do you as the CFO look to prepare for something like that?
You know, I think we'll see how the regulation unfolds, and clearly it's a little too early to tell from your question. But with that being said, I think we've been on a path of growing capital for the last several quarters, and we expect to do that. And I think that is in light of the uncertain economic environment, but also some of the potentialities where our regulations will go. And I think, by the way, that's broadly held within the regional banking space, and you're going to see higher capital levels sort of across most of the banks over the next several quarters.
Well, along the same lines, First Republic Bank has been rescued, at least temporarily, with the consortium of 11 banks. Zach, what kind of outcome do you think will happen and will be best for the banking sector as a whole when it comes to First Republic?
You know, that's going to be something that will evolve over time. Hopefully, the First Republic will be stabilized, and I think we'll see on Monday when they report results just how stable they are. But I would expect to see them continue to be able to grow organically, albeit if there's some other resolution path, you know, that could also be a positive outcome. We'll have to see.
Yeah, Zach, and I appreciate that you guys don't have direct exposure to that backstop from First Republic as well. So, Zach, as we round out the conversation, and I know you're the CFO, but still, we talked about services reaccelerating. We talk about the economic data continuing to surprise. Everyone knows there's going to be a recession coming. They're prepping for it, but today it's not actually happening. When you look out, how do you prep for that? How do you prep for a potential downturn that no one's actually seeing yet in the data?
This is the best forecasted recession that's yet to happen. I think for us, it's about being really strong on credit. That's a hallmark of ours. We stay steady and consistent and conservative. It's about being very well reserved. It's about having a recession readiness playbook where the whole organization knows how they'll perform and what actions might need to take if the economic environment worsens. And it's about capital and continue to grow capital and ensure that the company is strong and we can stay on strategy. We can continue to operate our game plan even in the face of uncertain economic environments.
All right, Zach, I'm afraid we're going to have to leave it there. Great talking to you today. Zach Wasserman, Huntington Bank CFO. Now, coming up, China's ramping up its investment in Zimbabwe, especially when it comes to a key metal used in electric car batteries. We're going to talk about how the West is responding next on Bloomberg.
Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. In the UK, Prime Minister Rishi Sunak's deputy Dominic Raab has quit after an investigation into bullying complaints. The probe criticized Raab's behavior towards civil servants. It's a major blow to Sunak. He's tried to present his government as a contrast to the Boris Johnson era, which was marked by political scandals. Raab will be replaced by Oliver Dowden, which is a close political ally of the Prime Minister. Florida Governor Ron DeSantis will test the international waters ahead of a possible decision to run for president. DeSantis will pay a courtesy call on Japan's Prime Minister Fumio Kishida during an international trade mission. A new Wall Street Journal poll shows DeSantis trailing Donald Trump 51 to 38 among likely Republican primary voters. And President Biden will crack down on U.S. investment in key parts of China's economy. Bloomberg's learned he'll sign an executive order in the coming weeks that will limit investing in Chinese semiconductors, artificial intelligence, and quantum computing. The president's hoping to get the backing of its G7 partners. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Alex.
All right, Angel, thanks a lot. Let's get more on those tensions between the U.S. and China. Bloomberg's Anne-Marie Hordern joins us at the White House. Anne-Marie, what do you think we're going to realistically see? At the same time, the House Ways and Means Committee are looking to sort of add back the tariffs on Chinese goods to the U.S. as well.
Well, when it comes to what the White House has been looking at really since the Biden administration started was how they could make sure they are confronting China in the economic sphere. And also, I think what's really was prevalent this week, especially with Treasury Secretary Janet Yellen giving this extensive speech on how she views Beijing and Washington's relationship on the economic forefront, it was actually that national security concerns outweigh those from the economic perspective. And that's really what's out in front and center with this potential outbound investment curbs. Now, the United States, though, if they're going to tell American businesses not to go into some of these, not to invest in some of these Chinese businesses, whether it's AI or quantum computing, things that potentially could enhance and help the Chinese military, they don't want to do it alone because guess what? If the U.S. tells their businesses they can't invest, someone else will just go fill that space. So what they're really trying to do and work towards, according to our reporting, especially Jenny Leonard, who has this story out, is they want to be able to make sure that they have a multilateral approach with European partners and potentially Japan as well as they lead up into the G7 at the end of next month in Hiroshima.
What's the likelihood other G7 members, Anne-Marie, will follow on, will likely adopt a similar approach?
Well, so when you look at the export curbs, the semiconductor curbs, the Netherlands and Japan signed up alongside the United States. So that was a huge win for this administration. They didn't go it alone, and they really wanted to take a multilateral approach prior to the Trump administration, which really went after China, but did so a lot of the times in a unilateral way. The issue they have right now is potentially one of optics, and it remains to be seen whether or not all European partners are going to sign up for it, because it's very obvious that Emmanuel Macron had this huge trip to China. Xi Jinping considered it a massive coup. He talked about strategic autonomy for Europe, but just yesterday there was a phone call between President Biden and Macron. So potentially the U.S. is making sure they are shoring up that support and that the French president does see eye to eye with Washington, because what it looked like following that trip was that he was a little bit going off slightly rogue, and where the Washington sees this relationship as well as your other European allies. You know, I've spoken to a number of European officials and they were just as annoyed about Macron and that trip as were officials here in Washington.
Interesting. I mean, we've seen the impact of the connection between France and China, especially when it comes to luxury goods in the markets themselves. Anne-Marie, thank you so much. As always, Bloomberg's Anne-Marie Hordern there. Now, in Zimbabwe, the lithium industry has been growing at a rapid pace thanks to a flurry of investment by Chinese mining companies. Now, lithium is a key component in batteries used by electric vehicles, and China's growing presence in the supply chains is raising concerns, as you might imagine, with what Anne-Marie was just saying when it comes to the White House in China. With us now is Bloomberg's Jennifer Zabazaja. So, Jen, how is America, how is Europe going to respond, again, if they're looking at investment curbs in China, going to respond to China's growing presence in this African market?
Yeah, I mean, growing presence, growing dominance, I think, really, Danny, is what we're seeing. And specifically in Zimbabwe, I mean, Zimbabwe is sort of positioned at this point in time to be the 6th biggest producer of lithium. So there's a real acknowledgement of the importance of this this country. And really what we're seeing, at least from the Chinese perspective, they've been investing for years into this country. They've been investing into refineries. They've been building up their own mines. And so there's a lot of catch-up that the U.S. and the West has to do, and there's a lot of acknowledgement about the catch-up that is needed to be done. At this point in time, the U.S. is really focused more with African countries and regionally on partnership, but China has been able to invest and put money into these countries. And so, you know, just talking about sort of the importance of lithium when we talk about the electric vehicle increase uptick that we're expected to see, it's really looking like Zimbabwe could potentially be one of many showdowns where we see the West and China really sort of fighting for production and fighting for investment, particularly with this mineral.
Jen, what would stand in the way of Zimbabwe or other parts of Africa that have lithium deposits of really being able to develop them?
Yeah, I mean, we were at the Zimbabwe investment conference this morning, Alex, and what we heard from officials is really not much would stand in the way. I mean, they know the importance of this mineral to the world, and they think that despite their struggling economy, struggling now for about 2 decades, this could be a real boon for them. And so, in particular, they really sort of tout and are, you know, happy with what they've done, in particular in regards to lithium. They've recently banned raw exports of it, trying to cut down on artisanal miners. Some miners in the country have not been happy about that. But listen to what the finance minister actually told us today about, in particular, why they are doing this.
Zimbabwe is saying that in other African countries, we want more beneficiation of our key minerals. And lithium is a key mineral in Zimbabwe. It's an energy mineral of the future, as you know. So it's important that we must maximize value for Zimbabweans, for Africa. That's a good thing.
And that was the finance minister of Zimbabwe talking to us, Alex, there. But really, when you talk to a lot of people who are in the economy, a lot of the miners, there still is a lot of concern that the locals are not seeing the benefits of this. And so the government is really going to have to do a lot to continue to encourage more investment, in particular from the West, if they really want to be a part of what's going to be a boom in lithium production and demand going forward.
Well, was there much concern that you heard at the conference when it comes to U.S.-China relations and how that ultimately might impact Zimbabwe?
Not in particular. I mean, what they have seen, and they're like what we were mentioning, the Zimbabwe economy has really been struggling over the past few years. I mean, you take a look at the currency, you take a look at sort of the business environment there, a lot of Zimbabweans have left. And so at this point in time, what they need is investment. And so in whatever form that comes in, they are welcoming it. But, you know, when we think about Zimbabwe and China in particular, they have a pretty decent relationship, as we've seen with a lot of other African countries taking a relatively neutral stance and welcoming any sort of investment. And so the West is really going to have to maybe reposition what it is that they're planning to do there, and also reposition their messaging to make sure that it benefits the locals, as we heard from the finance minister there, so that they can get their own value add.
Jen, I just was like, I could talk about this literally for hours, but we do have to leave it there. I feel like how you do all of this greenly will also be another key issue for how to invest. Jen, thanks a lot. Really appreciate it. Thank you for bringing us that sound as well. Jen Zabasajja joining us. This is Bloomberg.
Just about 35 minutes until the end of cash equity trading here in Europe for the end of the day and the end of the week. Now, a pretty subdued session, as most sessions have been this week for European equities. Europe Stock 600 up just 0.1%. Now, a viewer did tell me that I should say on air, make a bet that we'd end the day unchanged today because it is an options expiry, and that means that the index usually stays pinned. But I have no crystal ball, and I have a very poor risk appetite, so I will not make any such bets today. What is on the move, though, this morning is the front end of the curve in Germany. Two-year yields, those are up about 3.5 basis points. This really ticked higher off the back of the European PMIs we got. They were much stronger across the board, especially when it comes to services. Those all over 50, over into expansionary territory. Now, manufacturing, that is still lagging, but it is clear that the consumer is still strong. For all of these bets that we're about to hit a recession, it's just not happening. It's not bearing out in the data, and consumers don't have to worry about energy prices. Now, we have seen a poor couple of days for commodities. Copper continues to fall down about 1%, trading on the London Metals Exchange. Now, some of it might have to do with some of that global growth concerns. Again, the narrative's there, but not necessarily the data, but also concerns about U.S.-China relations. Will that be a bad thing for metals and demand there? Now, coming up on the European close, we're going to be speaking with Roland Koyayan, SocGen head of European Equity Strategy, who joins us next. This is Bloomberg. It's Friday, the 21st of April. Hot services data has bonds under pressure. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
30 minutes ago until cash equity trading closes. I'm Danny Berger in for Guy Johnson. Alex Steele is in New York, and we're looking at a marginally stronger session in Europe. We have been pretty flat for most trading days this week. It is an options expiry week, so that keeps things a little bit subdued. Stock 600 up about 0.1%. German two-year yields, those are on the move higher after hotter PMI data across Europe. Services surprised the upside. They are well above 50. That line of growth and not growth, but manufacturing still a little bit weaker. And we also have the U.S. data, which perks this up as well. Copper, here's where you see some of the growth concerns coming in, which is kind of this ironic thing considering the data has been strong, considering it's forcing a sell-off in bonds. But yet we are selling commodities this week, the metals. There's a concern also with China and the U.S. If the U.S. is cracking down on investment in the region, if they're trying to convince other G7 nations to do the same, what will that mean for China and the region's demand for metals? And that's playing out, Alex, by seeing copper fall about 1% today.
Yeah, I also wonder how much that's tied to the weaker not weaker, but not as strong manufacturing over in Europe as well, as we're still working down those inventories. So the U.S. equity is trading a little bit softer. Danny was mentioning the super strong services PMI. I just want to point out things like new orders, the highest in months. You had prices also rising, prices being passed on, particularly in services, and we're accepting them here in the U.S. And the outlook for services also really strong all the way through May. Now, you can also see that on a non-services level, but a discretionary level, and that's Procter & Gamble. That's stuck up almost 4%. Their organic sales revenue for this year could be up 6%, better than originally estimated. They are still dealing with higher inflation, so their bottom line might not be as amazing. However, they're able to pass the costs on, and they're able to sell their stuff. And that's really helping the whole consumer staples index up by about 0.6%. But also consumer discretionary is the next best performing sector in the S&P. So it's not just relegated to toilet paper. And as Danny was pointing out in terms of a little pressure in the bond market, here in the U.S. even more so, 2-year yields up by about 5 basis points. The market's still pricing in 50 basis points of cuts by the end of this year. How does it do that if you're actually seeing an economy where the services data is re-accelerating, Danny?
I also noticed that in the Bloomberg survey of economists, everyone has been upgrading their outlook for GDP, basically for most developed countries except for Japan. That one, of course, has a bit of a different story. And part of what's guiding that is the data. Now, I have a chart here looking at the spread between manufacturing and services PMI, actually flipped around. And it's for the U.S., Germany, UK, and France. Basically, all these lines moving higher means that services are outperforming manufacturing. This is just a way to show that the consumer is still really strong. You can see since the start of the year, everything has been moving up. In other words, services keep outperforming manufacturing to a greater degree. We talked to S&P in the last hour, Alex, who said that there's still this inventory problem that Europe is trying to work through, hence why manufacturing is weaker in Europe than the U.S. I do just want to point out, because I think this is really interesting, the white line here is France, and it might be hard to see. I would suggest you go to GTV on your Bloomberg terminal if you can't see this, but France is at the top of the pile with the spread being 10.8. And part of the reason is because of all the protests we saw in Paris. That had a dampening effect on manufacturing, so that spread was even wider when it comes to the French data, Alex.
Yeah, and I should point out that Chris did say that this is, kind of the best it's going to get for a while, that we're still headed for a downturn, and this is basically, it's not canary in a coal mine, a dead cat bounce for the data. Okay, that's what he said in terms of the future. But what he said today about what's going on with services and manufacturing in Europe, he's behind the PMI data, Chris Williams from S&P, and we asked him about that spread and what was going on.
What you're seeing is a difference in the inventory cycle. The US manufacturing sector seems to have cleared out its inventories that were built up over the pandemic faster than we've seen in Europe. Europe's still really in the thick of that inventory clear out. So there's weak demand there, especially for intermediate goods, components that goes to other firms. In the US, that story is more played out, so it's acting as less of a drag. So you've not got really strong growth in manufacturing, but it is looking better in the US than Europe.
So that strong growth brings us to our question of the day. Is the economy reaccelerating? Joining us now is Bloomberg's Eurozone economy editor Alexander Weber and MLive editor Van Ram. Alexander, let me bring this to you. Given the PMI data we had today that surprised the upside, is the European economy reaccelerating?
Well, the data is consistent with what economists have been expecting, which is a gradual reacceleration of the economy after a weak winter. But as you already explained, there is a strong divergence. It seems like there's still a big adjustment taking place after the pandemic, a rotation of consumers' demand for goods back to services. That raises, of course, some questions about how sustainable this is. Will this pent-up demand eventually peter out, and will the weakness in manufacturing eventually affect services as well?
Yeah, I feel like we've been waiting for that, and it just still hasn't happened. It's just pushing. Everyone's looking for the weaker data and the recession, and then it's just not coming. Then how do we trade this data?
Well, that's a great question, Alex. I mean, we trade this data simply by being long treasuries and being short bonds relatively. It's a relative trade, so I think that bonds are going to underperform treasuries over the next 6 months or so, simply because the Fed looks to stop at 525, ECB is likely to go to 375, so there are at least 3 more hikes from the ECB coming in the pipeline, and one 25 basis point hike remaining from the Fed. So that would lead to underperformance in bonds relative to treasuries.
In general, though, then, when it comes to the bond buying month we had last month, driven by the banking crisis, yeah, it's come back a little bit, but are we too optimistic that enough damage has been done to the economy? Again, considering these numbers we've gotten after the banking crisis, are we too optimistic that the Fed is almost done?
Well, you've got to go by the dot plot, and the dot plot says 525 is the top rate. Now, you raise a valid point, Danny. I mean, is the economy accelerating, and is it accelerating enough for the Fed to go another leg higher? I think that they are going to stop at 525 and pause and assess the lay of the land. And then if the economy reaccelerates beyond the second half, and that's crucial because what we are seeing at the moment is the long tail of the economy wagging, and that wagging will take some time. And if you see the 3-month 10-year yield curve, it's been in consistent inversion since November. And usually there's an 11-month lag before the economy goes haywire. And that should happen in October at the earliest this year. So it all comes down to the second half story. And I don't think that the Fed is going to be keen enough to raise too much higher from here. Unless, of course, the inflation reaccelerates all over again.
No, fair enough. It just really brings into question those 50 basis points of cuts we're still pricing in. To your point, we're going to feel the pain maybe October, but I don't know. All right, Alexander, if I'm at the ECB, what do I think about this data? Do the doves have to stop complaining about tighter credit conditions and weaker loan growth and things getting really bad?
Well, the PMIs are, of course, not the only thing the ECB looks at, so we're still getting very important data on exactly that, on bank lending, just before the ECB meeting. But on its own, it supports the case, at least for ongoing hikes, and may even push them closer toward a 50 basis point increase if they conclude that there's really more to do. If all the other data on inflation, on bank lending go in the same direction, then it certainly supports the case for more and perhaps even one more 50 basis point hike.
Alexander, how much of a difference has the fiscal stimulus around energy made when it comes to what we're seeing in the real economy in Europe?
So from the ECB's point of view, they are complaining that these measures haven't been withdrawn quickly enough and that they are still fueling consumers' demand. And you can see that in the ongoing demand for services, that the energy crisis has waned pretty quickly and it hasn't dented consumers' demand to the extent that many were expecting last year.
Yeah, what the governments did works for the short term. So now what do we do? Ben, last word to you. I appreciate this is the European close hour. However, based on what you were talking about before, it feels like those 50 basis points of Fed cuts could actually be really mispriced. Do you think that that's true?
That's absolutely true, Alex. I don't think that the Fed is very keen to cut rates at any time, at any point soon. Look, they themselves, if you look at the Fed dot plot, they don't see the inflation converging to 2% before 2025. So it would take extreme stress in the markets and a tightening of financial conditions for the Fed to cut rates. If it's just a recession without any systemic stress, they are not going to cut rates because this is not a Fed that's going to and that's going to reduce rates at the drop of a hat. I think that's something the markets haven't got around to, and they will get used to by the end of this year. This is a different trend. This is a different inflation era we are living in, and the markets haven't quite come around to it yet.
Yeah, it's like, what's it going to take for that to change? All right, guys, thanks a lot. Really appreciate it. Wonderful way to set us up. Alexander Weber and Van Ram, thanks a lot. Have a nice weekend. All right, coming up, we're going to put this question of the day: is the economy reaccelerating? To Roland Claudioyen, a European equity strategist over at SocGen. This is Bloomberg.
We have to be, I think, cautious. It does not mean that we stop, or it means that we decide meeting by meeting on the basis of the information that we get. Wages and profits. And this is what we are looking at, whether the wages will make up and whether profit margins will remain unchanged.
The Bank of Italy governor there speaking exclusively to Bloomberg's Francine Lacqua earlier, and he's talking there about being data dependent, deciding meeting to meeting. Well, the data we've been getting is strong, at least when it comes to the consumer services PMI throughout Europe, surprising to the upside today. And that brings us to our question of the day: is the economy reaccelerating? Joining us now is Roland Claudioyen, European equity strategist at Societe Generale. Roland, good morning to you. So looking at the data we've gotten today, are you also seeing a re-accelerating European economy?
Well, I would not say re-accelerating. I would say a resilient economy, European economy. And this is somehow what the market, starting to price in. When you look at the performance of European equity since the beginning of the year, it has been very strong, one of the strongest in the world. No? And that could be clearly explained by the fact that the economy has been very resilient, and the number we got today confirmed this resilience.
So do you sell the resilience now at this point, if you feel like it's already priced in?
I think that's, yeah, I mean, when you look at valuation in the market, when you look at sectors, the best performers sectors in the beginning of the year, you will find, many cyclical sectors that are benefiting from a lot of good news we have since the beginning of the year. You mentioned the data on the consumer side. That's a point. We can also mention the story on reopening China, which also affecting a lot of European companies. And also we can mention now that the winter is over, all the problematic on the energy supply and the energy crisis in Europe. It's also very reassuring after the winter.
How much of that China story is priced in at this point? When you look at an LVMH that's already at a record high, that's already up 32% this year, at what point do you say, all right, that's all baked into the pie?
Look, on the luxury goods sector, what I can tell you is that the sector is back to all-time high relative valuation versus the market. So that tells you something. That tells you really that, you know, in terms of what is pricing in the market and for the future earnings, expectation is already very high. So the China reopening has been a very strong story for this sector. You have other sector that has benefited also from this news flow. For example, a very obvious one is travel and leisure, also one of the best performers in the beginning of the year. So I would say, you know, the China story is well priced in now in a lot of sectors.
You know, we were talking to somebody the other day about this too. It feels like we could have made the same argument though 3 months ago and missed out on another kind of rally. Are you surprised at the resilience of some of these names? We talk about the resilient economy. Are you surprised about the resilient rally?
That's a good point. What we have seen is a big sell-off in March, right? And then the market has fully recovered from the sell-off and is even slightly higher. But what is interesting, and we look into that into details, if you look at how the market evolved over the last 3 months, what is quite amazing is that it has been more led by defensive sector. Right, and so you're right saying that a lot of, you know, big part of the story on cyclical, on the resilience of the economy of China was already there probably in February, but what we have seen over the last 2-3 months is that the market has been more driven by defensive sector. If you look, the best performers since the beginning of February is going to be healthcare, is going to be food and beverage, is going to be utilities, telecom. So those very defensive, low beta sector. How we interpret that is that the market is clearly moving without big conviction right now in Europe.
Yeah, I got to say, it feels like that everywhere, not just in Europe, but the U.S. as well. Well, and are you looking for any more details of where we stand in Europe when we get bank earnings tomorrow? Not tomorrow, next week. We won't get any tomorrow, I promise. What are you looking out for next week when it comes to those European bank earnings?
What I will look on the European earnings is clearly where we're going to stand on the margin. That's the question I got every day for the biggest investors. You know, where the margin will go, because we are such a high level compared to historical standards. You know, company has been able to increase price at much faster price than cost increase. So what we have seen last year, the story was we have seen margin expansion. So it's all about, for me, the question is going to be all about the margin and the capability to European companies to protect those margin. So that's going to be the big question mark for this quarter and the quarters to come.
Before I let you go, and I appreciate you're the equity analyst, if the data means we're going to have to see a more consistently aggressive ECB, where is that not yet priced in?
I think that what the market is probably missing is on the rate side. I think that, you know, with strong data as we have seen today, we can see the ECB continuing the fight against inflation, and we can see much higher bond yield, much higher rates. And what has been completely left behind by the market, what is not priced in, is on the value sectors, on the value side of the market, which is traded with a heavy discount compared to historical standard. That is a place where we see a lot of opportunity, and that is a place that could be that could clearly benefit from increase in rates and increase in rising bond yield in the coming months.
Hey, Roland, thank you so much for joining us. We're going to have to leave it there. Roland Carillon, European Equity Strategist at SocGen. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. Glencore says it's on course for yet another bumper year of trading commodities. Energy products contributed to strong first quarter performance. While its trading business is booming, Glencore is also trying to expand its mining operations. It's in the middle of a fight to buy Canadian mining rival Teck Resources. Here in the UK, two insurers have become the first major companies to quit the Confederation of British Industry. That follows a report involving allegations of a second case of rape at the business lobbying group. Aviva and Phoenix Group have canceled their memberships. Aviva says the CBI is no longer able to represent corporate Britain. And the biggest global luxury conglomerate is shifting resources out of Hong Kong. Bloomberg has learned that LVMH wants to focus more of its investment in mainland China cities. Hong Kong used to be Asia's premium shopping hub, but mainland Chinese consumers have switched to buying luxury goods in their home offices. And that is your latest Business Flash. Danny?
All right, thank you very much, Angel. All right, let's get your last calls in and take a look where European markets are trading as we head into the close. Kicking things off with Man Group here. This got an upgrade from UBS saying that the valuations are really attractive, that there were some concerns about performance fees, but at the moment, all of that is baked into the picture. Again, an upgrade, a new buy on Man Group. Also looking at Veolia. Now, this one is also an upgrade. It's not just an upgrade on Veolia, I should say. It's really a lot of European utilities. This one comes from Deutsche Bank, just saying that in this space, earnings are going to be improving. The pace of that is going to be better. So Veolia trading higher today by about 1.1%. Again, that is a buy from Deutsche Bank. Now, finally, Alex, you and I have been talking a lot about EVs, and here is a nice little EV upgrade. This one's also from Deutsche Bank, the idea being that there's more demand for EVs, which again might be a little bit confusing considering some of the Elon Musk and Tesla stories we have heard, that perhaps demand isn't as robust, but Deutsche Bank does see it as robust. And because there's more EV demand, there needs to be more EV charging stations. So Alfen is a company that makes them, so Deutsche Bank gives that one an upgrade, essentially saying that, look, this is going to be doing better, up 2.9%. Now, one share...